Hey everyone, welcome back. Today we're going to talk about Cigniti Technologies, a mid-cap IT company that has quietly built a strong track record in digital assurance and engineering services. The company recently announced its Q2 FY26 results, and the performance this quarter has been quite impressive, both in growth and profitability. Let's start with the numbers. Cigniti's revenue for the quarter stood at about 567 crores, which is a solid 25% growth compared to the same quarter last year. The net profit came in around 82 crores, up nearly 56% year-on-year, a big jump that shows how efficiently the company has been managing its operations. Even on the margin side, the EBIT stood close to 100 crores, with operating margins expanding to almost 17.5%. That's a strong improvement, especially in a period when most IT companies are facing margin pressure due to global uncertainties. If we look at the half-yearly performance, revenue for the first half of FY26 is up by nearly 14%, and net profit has grown by more than 130% compared to the same period last year. That shows the momentum is not just in one quarter, it's a consistent trend. On the management front, there's also an update. The company announced a CFO transition, with Mr. Ashish Arora taking charge from October 28th. Leadership changes like this are part of strengthening the next phase of growth, and given Cigniti's execution track record, the transition looks well planned. Now let's talk about the business side. Cigniti has been focusing on high-value segments like digital assurance, automation, cloud migration testing, and AI-led quality engineering. As global enterprises accelerate their digital transformation, demand for these services is growing steadily. The company has been expanding its client base and cross-selling new solutions to existing customers. It's also focusing heavily on improving margins through better project mix, operational efficiencies, and stronger offshore delivery ratios. Coming to the stock, the current price is around 1,680, with a 52-week range between 1030 and 1970. It's a mid-cap stock with a market capitalization of roughly 4,600 crores and trades at a price-to-earnings ratio of about 26 times, quite reasonable for its growth rate and return profile. The company has a healthy balance sheet with low debt and a return on equity of around 27%, which reflects strong capital efficiency. For investors, the ideal long-term entry zone is between 1,600 and 1,700. And those who already hold the stock can look at partial profit booking near the 1900 to 2000 zone, close to its previous highs. From a long-term perspective, the company's business fundamentals remain very strong, so staggered buying on dips makes sense for investors with a growth-oriented view. Looking ahead, analysts expect Cigniti to continue benefiting from the global shift toward digital assurance and automation. With new client wins, higher repeat business, and margin improvements, the growth outlook remains encouraging. Of course, one should keep an eye on broader macroeconomic factors like global IT spending and currency movements, which could cause short-term volatility. But overall, the company is well-positioned for sustainable growth. So to sum it up, Cigniti Technologies is shaping up as a steady growth compounder in the mid-cap IT space. It combines strong revenue visibility, improving profitability, and consistent execution. For investors looking to add a quality IT stock with both stability and upside potential, Cigniti is definitely one to keep on the watch list or in the portfolio. That's all for today's update. If you found this analysis useful, make sure to like, share it with other investors, and stay tuned for more data-backed stock reviews coming up soon.